Good morning once more, grade 12 learners and educators. Welcome to the revision sessions. Today I am Mr. Masango, the Provincial Subject Coordinator for Accounting. Today we are going to look at note number 3, commonly known as the note for fixed assets or tangible assets. This is actually grade 11 work. But surprisingly, some of you are still struggling with this note. And this note is frequently asked in question papers, either as a note on itself, or it can be coupled with the cash flow statement, or you may be required to make certain calculations in the balance sheet, and you still need the note. Therefore, the note is an integral part of the accounting syllabi. Even in the income statement, you might be required to prepare the depreciation account, the depreciation amount for the year, or you might be requested to calculate either a profit or a loss on sale of asset. And all these require a knowledge of note number 3. All right. Before we start on the activities, there are a few things that I would like to, concepts that I would like us to clarify. Many of you are confused by the concept carrying value. Carrying value. Carrying value is actually cost price. When you calculate carrying value, you say cost price minus accumulated depreciation. Cost price minus accumulated depreciation will give you your carrying value. This is actually your book value. This is your book value. This is the net worth or the net value of an asset. This is the net value of an asset. What does that mean? It means now if you want to sell your asset, you must at least sell it at this value. For an example, if my cost price is 100,000 and my accumulated depreciation on this asset is, let's say, 70,000, then it means my carrying value is 30,000 or my book value is 30,000. If I want to sell this asset, I must sell it at least for 30,000. If I sell it for less than 30,000, then I will sustain a loss on that transaction. If I sell it for more than that, then it means I will sell it at a profit. Now, there are two methods of calculating depreciation. Two methods of calculating depreciation. We have what we refer to as the cost price method. Sometimes referred to as the straight line. Straight line, why? Because you write off the same amount. You depreciate by the same amount every year. That is what they mean by straight line. Then we have your diminished balance method. With the diminished balance, before you can make the depreciation account, you must first subtract accumulated depreciation from the cost price, which is actually the same concept as that. You calculate it on the carrying value. You calculate it on the carrying value. Here you calculate the depreciation on the cost price. So basically, that is how that is done. Now, let us now move very quickly to an activity. I've taken this from previous year's papers so that you are prepared when such a question arises. The first activity is much easier, and we will quickly go through it. Remember that the first session is for 45 minutes, And then if you have any questions, please send them through and we will handle those questions after the break. After the first 45 minutes, we are going to have a 5 minutes break. And then any questions that you have, please send them through and we'll respond to them thereafter. Right. Now, you are given information of Master Limited. They say you are provided with information relating to Master Limited for 30 June. Financial year is very important when you are dealing with this type of activity, of question. Now, if the financial year ends on 30 June 2012, it means it started on 1 July 2011. It is very important that I have my timeline. You will see later on why it is important to have that. Now they say use this information to complete the note for fixed or tangible assets by filling in the missing figures indicated by an asterisk. You need to calculate additions at cost for land and buildings. You need to calculate additions at cost for equipment. You need to calculate depreciation for equipment, carrying value for equipment at the end of the year, accumulated depreciation at the end of the year, disposal at carrying value for vehicles at the end of the year, cost price of vehicles at the end of the year, and accumulated depreciation at the end of the year. Right. Now let's start. In addition to that information, you are given extra information. The first information says, land and buildings were bought during the year, and as you know, land and buildings are not depreciated. They just tell us that they were bought, but they don't tell us for how much. Therefore, we must calculate that amount, additions to land and buildings. Now that will be additions. Then you have your answer sheet. On your answer sheet, you will write additions. These additions are at cost price. Additions at cost. Now, you are given a partly completed answer sheet. They tell us that at the beginning of the year, we had land and buildings of 930,000. At the end of the year, our land and building has increased to 1,580,000. Therefore, in order to calculate additions at cost, it's a simple arithmetical calculation. We say land and buildings at end of the year was 1,580,000. And then from that, we subtract the land and buildings at the beginning of the year of 930,000. Now, 1,580,000 minus 930,000. Now, it gives us 650,000. Then you have your 650,000. This is basic arithmetic. Anyone should be able to do that. What we simply did, we said land and buildings at the end of the year minus land and buildings at the beginning of the year. It gives us the land and buildings that were purchased during the year. And for that, you get 2 marks. For that simple calculation, you get 2 marks. Right. The second part of the question, now we go to the second bullet. They say, new equipment was bought for 55,000 halfway through the financial year. This transaction has been correctly recorded. Which means that amount is included here, is included there. Right. So this one is very simple because they told us that new equipment has been purchased for 55,000. You simply put it here, 55,000. Alternatively, if the amount was not given, you will still be able to calculate that amount. You would take your equipment at the end of the year, which is 616,000, and you will subtract equipment. Remember, you see I'm using cost. I'm using cost. You take the cost price of equipment at the end of the year minus the cost price of equipment at the beginning of the year, minus 561,000. Here we got 650,000. Now we are going to say 616,000 minus 561,000. Voila, 55,000, which is the same amount that has been given to us. The point that I'm trying to make is that even if you are not given that amount, you would have still been able to calculate it. Okay? Fine.